Hey, what's up, everybody? This is Angel with Alpha Capital. I am so excited to bring you this program. It doesn't matter if you're a beginning trader, an advanced trader, you've been trading for years, or just days. By the end of this program, you're going to understand price action. You're going to understand the reason why the market is moving the way it's moving, and you're going to know how to place trades and when to place them based off of candlestick patterns, support and resistance, and a few indicators that I will get into. I have sectioned this off into 6 different sections throughout this course so that it's easy to understand. The first one being candlestick anatomy. Just as humans, candlesticks have different body sizes, and when it comes to trading, it's important to check out the bodies of the candlesticks and understand the psychology behind it. That's what you'll learn in the first section. And in the second section, candlestick patterns, we'll learn because they're an integral part of technical analysis. Candlestick patterns emerge because human actions and reactions are patterned and consistently repeated. We'll learn how to recognize the most important candlestick patterns, the psychology behind its formation, and what do they indicate when they form in the market. In section 3, we'll be talking about the market structure. We'll learn how to identify trending markets, ranging markets, and choppy markets. You will learn how these markets move and how to trade them professionally. You will also learn how to draw support and resistance and trend lines. In section 4, we'll be speaking about time frames and the top-down analysis that I use. Multiple time frame analysis is very important for you as a price action trader. In the 4th section, we will be learning how to analyze the market using the top-down analysis approach. In the 5th section, I'll be showing you some trading strategies and tactics. We'll be learning the pin bar strategy, the engulfing bar strategy, the inside bar strategy, the inside bar false breakout strategy, and I'll show some trading examples. In section 6, we'll be talking about money management. I will show you how to create a money management and risk control plan that will allow you to protect your trading capital and consistently become profitable. So without further ado, let's just jump right in. So the candlesticks have been around a lot longer than anything similar in the Western world. The Japanese were looking at charts as far back as the 17th century, whereas the earliest known charts in the U.S. appeared in the late 19th century. Rice trading had been established in Japan in 1654, with gold, silver, and seed oil following soon after. Rice markets dominated Japan at this time, and the commodity became more important than hard currency. Munihisha, the rice trader, he's credited for being one of the early exponents of tracking price action, which is super important in Forex. He understood the basic supply and demand dynamics and also identified the fact that emotions played a part in the setting of a price. He wanted to track the emotion of the market players, and this would become the basis of the candlestick analysis. He actually was very well respected, and to the point he was promoted to samurai status in Japan, which is pretty cool. The Japanese did a good job at hiding the candlesticks from the Western world right up until the 1980s, when there suddenly was a large cross-pollination of banks and financial institutions around the world. That's when the Westerners suddenly got wind of these magical charts patterns. Obviously, this was about the time that charting in general suddenly became a lot easier due to the widespread use of the PC. In the late 1980s, several Western analysts became interested in the candlesticks. In the UK, Michael Feeney, who was the head of TA of London and Sumitomo, began using candlesticks in his daily work and started introducing the ideas to other London professionals. He actually wrote a book about the candlestick patterns. If you want to check it out, you should check it out if I don't have enough information here for you. Candlesticks are important to your trading analysis because it's considered a visual representation of what is going on in the market. By looking at the candlestick, we can get valuable information about the open, high, the low, and the close of the price, which will give us an idea about the price movement. Candlesticks are flexible. They can be used alone or in combination with technical analysis tools such as moving averages and momentum oscillators. They can also be used with methods such as the Dow theory and the Elliott wave theory. I personally use candlesticks with support and resistance, trend lines, and other technical tools that I'll show you later on. The human behavior in relation to money is always dominated by fear, greed, and hope. Candlestick analysis will help us understand these changing psychological factors by showing us how buyers and sellers interact with each other. Now, when you understand that that's what Forex is and that's what the markets all are, just let that sink into your head. Candlesticks provide more valuable information than bar charts. Using them is a win-win situation because all you can get is the trading signals that a bar generates and the added clarity and additional signals generated by the candlesticks. Candlesticks are used by most professional traders, banks, and hedge funds. All right, let's go. So what is a candlestick? Japanese candlesticks are formed using the open, high, low, and close of the chosen time frame. If the close is above the open, we can say that the candlestick is bullish, which means that the market is rising and in this period of time. Bullish candlesticks are always displayed as a white candlestick. Most trading platforms use white to refer to bullish candlesticks, but the color doesn't matter. You can use whatever color you want. The most important is the open price and the close price. If the close is below the open, we can say that the candlestick is bearish, which indicates that the market is falling in this session. Bearish candles are always displayed as black candlesticks, but like I said, this is not a rule. You can customize them. You can find different colors used to differentiate between bullish and bearish candlesticks. The filled part of the candlestick is called the real body. The thin lines poking above and below the body are called shadows. The top of the upper shadow is the high, and the bottom of that lower shadow is the low. Have different body sizes. Long body refers to strong buying or selling pressure. If there's a candlestick in which the close is above the open with a long body, this indicates that buyers are stronger and that they are taking control of the market at this period of time. Conversely, if there is a bearish candlestick in which the open is above the close with a long body, as you see there, this means that the selling pressure controls the market during this chosen time frame. Short and small bodies indicate little buying or selling activity. Upper and lower shadows give us important information about the trading session. Upper shadows signify the session's high. Lower shadow signifies the session's low. Candlesticks with long shadows show that trading action occurred well past the open and close. Japanese candlesticks with short shadows indicate that most of the trading action was confined near the open and close. If a candlestick has a longer upper shadow or short lower shadow, this means that buyers flexed their muscles and bid the price higher. But for one reason or another, sellers came in and drove the price back down to the end of the session, back near its open price. If a Japanese candlestick has a long lower shadow and a short upper shadow, this means that sellers flashed their waterboard abs and forced price lower. But for one reason or another, buyers came in and drove the prices back up to end the session back near its open price. Candlestick patterns are one of the most important and most powerful trading concepts. They're simple, they're easy to identify, and very profitable setups. A lot of research has confirmed that candlestick patterns have a high predictive value and can produce positive results. I personally trade candlestick patterns for the last 7 years. I can't really switch to another method because I've tried many methods, and there's no success. The only strategy I've really found true success with, without having too much stress and without thinking too hard about the trade, would be trading candlestick patterns, support and resistance, RSI, and using confluence, which is combining multiple indicators of a trade together to confirm your trade with high probability of success. I'm not telling you I'm giving you the holy grail, but this trading system works. But be prepared to lose some trades, as losing is part of the game. If you're looking for a 100% winning system, I highly recommend that you stop trading and go look for another business. Candlestick patterns are the language of the market. Imagine you're like living in a foreign country and you don't speak the language. How could you live there if you don't even know how to say anything? It would be tough, right? That's the same thing when it comes to trading. If you know how to read the candlestick patterns the right way, you will be able to understand what these patterns tell you about the market dynamic and the trader's behavior. This skill will help you better enter and exit the market in the right time. In other words, this will help you act differently in the market and make money following the smart guy's footprints. Me. The candlestick patterns that I'm going to show you here are the most important patterns that you'll find in the market. Mind you, there's a lot of them, okay? But I compiled them into a few that you can just follow to just make money, man. Wake up! I'm just kidding. Let's get into this next part. The engulfing bar, as it states in its title, is formed when it fully engulfs the previous candle. The engulfing bar can engulf more than just one previous candle, but to be considered an engulfing bar, at least one candle must be fully consumed. The bearish engulfing is one of the most important candlestick patterns. This candlestick pattern consists of two bodies. The first body is smaller than the second one. In other words, the second body engulfs the previous one. This in front of you on your screen is what a bearish engulfing bar looks like. Alright? This is what it's going to look like in your charts. This candlestick pattern gives us valuable information about the bulls and bears in the market. In the case of a bearish engulfing pattern, the bar tells us that the sellers are in control of the market. When this pattern occurs at the end of an uptrend, this indicates that the buyers are engulfed by sellers, which signals a trend reversal. As you can see, when this price action pattern occurs in an uptrend, we can anticipate a trend reversal because buyers are not still in control of the market and the sellers are trying to push the market to go down. You can't just trade any bearish candlestick pattern you find on your chart. You'll want to incorporate other technical tools to confirm your entries. We'll talk more about that in the later sections of this course, but right now what I want you to do is open up your charts and try to identify any and all bearish candlestick patterns that you can find. And mind you, we're looking at the daily, 4-hour for those. You'll see them in the lower time frames, but until you're a more advanced trader, we'll be looking at the 4-hour and the daily so you get the bigger picture. The bullish engulfing bar consists of two candlesticks. The first one is a small body, and the second is the engulfing candle, as you can see in front of you. The bullish engulfing bar pattern tells us that the market is no longer under the control of sellers, and buyers will take control of the market. When a bullish engulfing candle forms in the context of an uptrend, it indicates a continuation signal. So keep that in mind. When you see this bullish engulfing candlestick happen as it's already going into an uptrend, you really know that thing is about to just keep on soaring upwards. When the bullish engulfing candle forms at the end of a downtrend, the reversal is much more powerful as it represents the capitulation bottom, as you'll see in the next slide. The example that you see in front of you clearly shows us how the market changes direction after the formation of a bullish engulfing pattern. The smaller body that represents the selling power was covered by the second body that represents the buying power. The color of the bodies are not important. What's important is that the smaller one is totally engulfed by the second candlestick. Don't try to trade the market using this price action setup alone because you will need further factors and confluence to decide whether this pattern is worth trading or not. I'll talk about that again in the later sections. What I want you to do now is get into the skill of identifying the bearish and bullish engulfing bars on your charts. It's very important that you visually see what I'm talking about. The more you see the pattern repeat itself in history, if you go back into the charts and just look for every single one you can find in the daily, in the weekly, in the 4-hour, you'll see exactly why that is a powerful pattern. The candlestick pattern for you guys. The chart in front of you shows how the motherfuckers have been listening. Cause shit, you know. If you did your homework, you'll see that engulfing pattern is quite successful. And if you know that, then just buckle on up, my titans, and just be prepared for these next couple of patterns because I promise you, make them fucking note cards, make them cheat sheets, have them on hand, watch for these patterns, never fail. Alright, let's get into it. Dragonfly Doji. The Dragonfly Doji is a bullish candlestick, meaning it's a buy candlestick, which is formed when the open, high, and close are about the same, or they are the same. What characterizes a Dragonfly Doji is that long lower tail that shows the resistance of buyers in their attempt to push the market up. The illustration I put in front of you shows us the perfect dragonfly doji. The long lower tail suggests that the forces of supply and demand are nearing a balance, and that the direction of the trend may be nearing a turning point. You see, the market was testing the previous fucking gravestone doji. That gravestone doji is the bearish, aka the buy version of the dragonfly doji. It is formed when the open and close are the same or about the same price. What differentiates the gravestone doji from the dragonfly doji is the long upper tail. The formation of the long upper tail is an indication that the market is testing a powerful supply or resistance area, as you can see in the example. The image that you're seeing illustrates a perfect gravestone doji. The pattern indicates that while buyers were able to push the prices well above the open, later in the day, sellers overwhelmed the market, pushing the price back down. This interpretation is a sign that the bulls are losing their momentum and the market is ready for a reversal. This chart above shows a gravestone doji at the top of the uptrend after a period of strong bullish activity. The formation of this candlestick pattern indicates that buyers are no longer in control of the market. For this pattern to be reliable, it must occur near a resistance level. As a trader, you will need additional information about the placement and context of the gravestone doji to interpret the signal effectively. But don't you worry, Titans. We'll get you there. Do yourselves a favor and go back into the market and look for that dragonfly doji and the gravestone doji. Find about 3 to 4 different instances of it and look what it does and take notes. Alright? Let's get into this next one. The Morningstar pattern is considered a bullish reversal pattern. It often occurs at the bottom of a downtrend and it consists of 3 candlesticks. The first candlestick is bearish, which indicates that sellers are still in charge of the market. The second candlestick is a small one, which represents that the sellers are in control, but they don't push the market much lower, and this candlestick can be bullish or bearish. The third candle is a bullish candlestick that is gapped up on the open and closed above the midpoint of the body of the first day. This candlestick holds a significant trend reversal signal. The Morningstar pattern shows us how buyers took control of the market from sellers. When this pattern occurs at the bottom of a downtrend near support level, it is interpreted as a powerful trend reversal signal. Here helps us identify the Morningstar pattern and how it is significant when it is formed at the bottom of a downtrend. As you can see, the pattern occurred at an obvious bearish trend. The first candle confirmed the seller's domination. The second one produced indecision in the market. That second candlestick could be a doji or any other candle. But here the doji candle indicated that sellers are struggling to push the market lower, and that third bullish candle indicates the buyers to control from the sellers, and the market is likely to reverse. This mindset is exactly how professional traders analyze the market based on candlestick patterns. And this is how you, my Titans, will analyze the financial markets. If you can master the anatomy of candlestick patterns and psychology behind their formations, you will always be good. Favor, go back into your charts, look for that Morningstar pattern. But let's jump into this evening star. The evening star pattern is considered a bearish reversal pattern that usually occurs at the top of an uptrend. The pattern consists of 3 candlesticks again. The first candlestick is a bullish candle. The second is a small candlestick, and it can be either bullish or bearish. It could be a doji or any other candlestick. That third candlestick is a large bearish candle. In general, the evening star pattern is the bearish version of the morning star pattern. The first part of the evening star is a bullish candle. This means that the bulls are still pushing the market higher. Right now, everything is going all right. The formation of the smaller body shows that the buyers are still in control, but they are not as powerful as they were. The third bearish candle indicates that the buyer's domination is over, and a possible bearish trend reversal is likely to happen. You'll see in the next chart, you'll see how an evening star could represent a significant trend reversal signal. The hammer pattern is created when the open high and close are roughly the same price. It is also characterized by a long lower shadow that indicates a bullish rejection from buyers and their intention to push the market higher. The hammer is a reversal candlestick pattern when it occurs at the bottom of a downtrend. This candle forms when sellers push the market lower after the open, but they get rejected by buyers, so the market closes higher than the lowest price. And as you can see, the market was trending down. The formation of the hammer, the pin bar, was a significant reversal pattern. That long shadow represents a high buying pressure from this point. Sellers were trying to push the market lower, but in that level, the buying power was more powerful than the selling pressure, which results in that trend reversal. The most important to understand in the psychology behind the formation of this pattern, if you can understand how and why it was created, you will be able to predict the market direction with high accuracy. So once again, do yourselves a favor, check out the last few patterns if you haven't already in the market. Find 5 different instances of it, and you'll see what I'm talking about. Hey, Titan, stay awake. This shit is important. Don't you want to be rich? Alright, now that I got your guys' attention back, let's shoot into this shooting star formation. The shooting formation is formed when the open low and close are roughly the same price. This candle is characterized by a small body and a long upper shadow. It is the bearish version, sell, of the hammer. Professional technicians say that the shadow should be twice the length of the real body. The illustration that I've shown you shows us the perfect shooting star with a real small body and a upper long shadow. When this pattern occurs in an uptrend, it indicates a bearish reversal signal. Every single time. Every single time. Every single time. I'm going to say it again. Every single time. The psychology behind the formation of this pattern, which is what makes it so significant, is that the buyers are trying to push the market higher. They got rejected by a selling pressure, and when this candlestick forms near that resistance level, it should be taken as a high probability setup. I'm talking about 99% accurate. All right? Take it. It's a shooting star. Make a wish. Pattern, pregnant in Japanese. It is considered a reversal and a continuation pattern, and it consists of 2 candlesticks. The first candle is a large candle and is called the mother candle, followed by a smaller candle which is called the baby. For a Hermione pattern to be valid, the second candle should close outside of the previous one. The candlestick is considered a bearish signal when it occurs at the top of an uptrend, and it's a bullish signal when it occurs at the bottom of a downtrend. As you can see, the smaller body is totally covered by the previous mother candle. Don't bother yourselves with the colors. The most important is that the smaller body closes inside the bigger first candle. The Hermione candle tells us that the market is in an indecision period. In other words, the market is consolidating. So buyers and sellers don't know what to do, and there is no one in control of the market. When this candlestick pattern happens during an uptrend or a downtrend, it is interpreted as a continuation pattern, which gives a good opportunity to join the trend. And if it has occurred at the top of the uptrend or at the bottom of the downtrend, it is considered a trend reversal signal. Again, as you can see in this chart above, you can see how the trend direction changes after Hermione pattern formation. The first bullish Hermione pattern occurred at the bottom of a downtrend. The sellers were pushing the market lower. Suddenly, the price starts consolidating, and this indicates the selling power is no longer in control of the market. The bearish Hermione is the opposite of the bullish. This one occurred at the top of an uptrend, indicating that the buyer's domination is over and the beginning of the downtrend is possible. When this pattern is created during an uptrend or downtrend, it indicates a continuation signal with the direction of the market. I like to repeat myself so that it stays ingrained in your head. We will study in detail how to trade this pattern either as a reversal pattern or as a continuation pattern in the next few slides. Formation is considered a bearish reversal. Tweezer's top formation consists of 2 candlesticks. The first one is a bullish candlestick followed by a bearish candlestick, and Tweezer's bottom formation consists of 2 candlesticks as well. The first candle is bearish, followed by a bullish candlestick. So we could say that the tweezer's bottom is a bullish version of the tweezer's top. The tweezer's top occurs during an uptrend when buyers push the price higher. This gives us the impression that the market is still going up, but surprise, 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 the sellers surprise the buyers by pushing the market lower and close down the open of the bullish candle. This price action pattern indicates a bullish trend reversal, and we can trade it if we combine the signal with other technical tools. The tweezer bottom happens during a downtrend when sellers push the market lower. We feel that everything is going all right, but the next session price closes above or roughly at the same price of the first bearish candle, which indicates that the buyers are coming to reverse the market direction. If this price action happens near a support level, it indicates the bearish reversal is likely to happen. In the chart in front of you, it shows us the tweezer's bottom that occurred in the downtrend. The bears pushed the market downward on the first session. However, the second session opened where the prices closed on the first session and went straight up, indicating a reversal buy signal that you can trade if you have other elements that confirm your buying decision. Don't focus on the name of the candlestick. Try to understand the psychology behind its formation. That is what's most important. Because if you can understand why it was formed, you will understand what happened to the market, and you can easily predict the price movement's future. All right, Titans, let's get think you smart, huh? Let's do another exercise. Look at the chart below and try to figure out these candlestick patterns. Hey, here we are. One of the most important skills that you need to learn as a trader is the ability to read the market structure. It is a critical skill that will allow you to use the right price action strategies in the right market conditions. You are not going to trade all the markets the same way. You need to study how the markets move and how traders behave in the market. The market structure is the study of the market behavior. And if you can master this skill when you open your chart, you will be able to answer these important questions. What are the crowds doing? Who's in control of the market, buyers or the sellers? What is the right time and place to enter or exit the market? And when do I need to stay away? Through your price action analysis, you will experience 3 types of markets: trending markets, ranging markets, and choppy markets. In these next few slides, we will learn how to identify every single market and how to trade them. The first one would be trending markets. Trending markets are simply characterized by a repeating pattern of higher highs and higher lows. Trending markets are simply characterized by a repeating pattern of higher highs and higher lows in an uptrending market, and lower highs and lower lows in a downtrending market. As you can see, the market is making a series of higher highs and higher lows, which indicates that the market is uptrending. You don't need indicators to decide if it's bullish or bearish. Just a visual observation of the price action is quite enough to get the idea of what the market is trending. As you can see here, the example shows a bearish market. There are a series of higher lows and lower lows, which indicate an obvious downtrend. Trending markets are easy to identify, so don't try to overcomplicate your analysis. Use your brain and see what the market is doing. If it is doing a series of higher highs and higher lows, it is simply an uptrend market. Conversely, if it's making a series of lower highs and lower lows, it's obviously a downtrend market. According to statistics, the trends are estimated to occur 30% of the time. So while they are in motion, you've got to know how to take advantage of these things. To determine whether a market is trending or not, you have to use a bigger time frame. Like I said earlier, use the daily or the 4-hour, or the weekly even. And don't try to use the smaller time frames to determine the market structure. If you can identify a trending market, it will be easy for you to trade it. If it is a bullish market, you will look for a buying opportunity because we have to trade with the trend. If the market is bearish, you will have to look for a selling opportunity. But the question is, what is the right time to enter a trending market? Because it could be real scary looking, thinking, oh, it's going to reverse right now. But you can't think that if you know what I'm teaching you. So trending markets are characterized by 2 important moves. The first move is called the impulsive move, and the second one is called the retracement, if you can see in the example that I've given. The market is making higher highs and higher lows, which indicates that bullish market. But if you see this market, you will think of buying. But as you see, the market's making 2 different moves. The first move is the impulsive move, and the second one is a pullback or the retracement move, the corrective move. Professional traders understand how trending markets move. They will always buy at the beginning of an impulsive move and take profits at the end of it. This is the reason why markets make impulsive moves in the direction of the trend and retraces back before it makes another impulsive move. If you are aware of how this trending market moves, you will know how to place the best buy is at the beginning of that impulsive move. Traders who buy in an uptrend market at the beginning of a retracement move, they get caught by professional traders. They don't know why the market hit their fucking stop loss before moving into predicted direction. Illustration shows a downtrend market. And as you can see, the best trading decision is to sell the market at the beginning of an impulsive move. If you try to sell the market in a retracement move, you will be trapped by professional traders and you will lose your trade. Now that we know how to identify these downtrends and uptrends, and how to differentiate between an impulsive move and a retracement move, this is very important for you as a price action trader to know. But the most important question, as you guys are all thinking in your heads, is how do I identify the beginning of the impulsive move to enter the market with the right time as the professional traders and to avoid being trapped by the retracement move? It's a good question. To predict the beginning of an impulsive move in a trending market, you have to master drawing support and resistance levels. What are support and resistance levels, and how do we draw them? Don't you worry, guys. My Titans will be getting into it next. Let's go! Resistance are proven areas where buyers and sellers find some equilibrium. There are major turning points in the market. Support and resistance levels are formed when price reverses and changes direction. The price will often respect these support and resistance levels, and in other words, they tend to contain price movement until, of course, price breaks through them. In trending markets, support and resistance are formed from swing points. In an uptrend, the previous swing point acts as a support level, and in a downtrend, the old swing point acts as a resistance level. You guys understand that? You see that in the illustration above? You see how it comes? There's that swing point where it's breaking. Breaks through that swing point, that breaking point becomes that support level. That next swing point is a resistance level. Then, once it breaks through that swing, aka resistance, that resistance turns into support, and so on and so forth. As you can see, that previous swing point is acting as a support level after the breakout. And when the market makes a retracement move, it respects that previous swing point, which will represent the beginning of another impulsive move. As you can see, when the market tests the previous swing point, it goes up again. By drawing a support level in an uptrend market, we can predict when the next impulsive move will take place. Let's see another example of a downtrend market. That you're seeing shows us how the market respects resistance levels. When price approaches this previous swing point, that resistance level, the market makes an impulsive move. If you understand how price action acts in a trending market, you will be able to predict with high accuracy when the next impulsive move will begin. If you've seen my Facebook, if you've seen my trades, and you wonder, how is he getting these big old trades? Is he holding them for days? What's going on here? Well, yes, that's what I'm doing. I'm looking at the big move, looking for the candlestick pattern, capitalizing on those patterns, stacking trades each and every single time. In conjunction with the support and resistance, there's also another way to identify when the beginning of the impulsive move is happening, and that is by drawing trend lines. I will explain to you how to draw trend lines a little bit more in the next couple slides, but basically what they are the market is making moves and making new swing highs and swing lows, and the price will tend to respect those linear levels, which are identified as a trend line. The bullish markets will tend to create linear support levels, and the bearish markets will form the linear resistance levels. How to draw a quality trend line. You will need to at least find 2 minimum swing points and simply connect them to each other. The levels must be clear, so don't try to force a trend line. Come on. Don't use a smaller time frame to draw the trend lines. Always use the 4-hour and the daily time frames to find the obvious trend lines. Now, please, there'll be all these Forex teachers that have probably told you how to draw trend lines. Man, just keep it simple. Keep it simple. This entire class is a strategy on how to trade, and the only strategy you need, okay? I put multiple things together, all that have a high probability rate of success. So if you follow this blueprint, you'll be good, all right? Now, what we'll try to focus on right now is how to draw them in a trending market. Our purpose is to identify the beginning of impulsive moves in a trending market. In the next slides, I will explain to you in detail how to trade trend lines in combination with our price action trading setups. Now, as you can see, the market respects the trend line. And when the price approaches it, the market reverses and continues in the same direction. When the market moves this way, trend lines help us to anticipate that next impulsive move with the direction of the market, not against it. Because why does that make sense? As you can see, the market respects that trend line, and by drawing it the right way, we can easily predict the next market movement upwards. And by the right way, I mean 2 points minimum. Connect them, you'll see your next points, literally. Right? Now, I think it's pretty clear and simple, hopefully. But if it's not, just open up your charts and try to find some trending markets. Find the previous swing points, the support and resistance, and try to find the trend lines as well. Just plot them. Plot support and resistance. Plot the trend lines. It will help you understand how trending markets move and how to predict high probability entries. I promise you, look. Just do it over and over again until your brain literally looks at the market like me, doesn't have to set support and resistance lines, doesn't have to set trend lines, doesn't have to do anything but look at the naked market and know what's going on. Now, for the ranging markets. Ranging markets are pretty straightforward. They're often called sideways markets because of their neutral nature makes them appear to drift to the right horizontally. When the market makes a series of higher highs and higher lows, we can say the market is trending up. But when it stops making these consecutive peaks, we can say the market is ranging. A ranging market moves in horizontal form, where buyers and sellers just keep knocking price back and forth between the support and resistance levels, as you can see in the example. The chart shows a ranging market, and as you can see, the price is bouncing between the horizontal support and resistance level. The difference between trending markets and ranging markets is that the trending market tends to move by forming a pattern of higher highs and higher lows in case of an uptrend, and higher lows and lower lows in the case of a downtrend. But ranging markets tend to move horizontally between key support and resistance levels. Your understanding of the difference between both of the markets will help you better use the right price action strategy in the right market condition. Trading ranging markets is completely different from trading trending markets because when the market is ranging, it creates equilibrium. Buyers are equal to the sellers and there is no one in control. This will generally continue until the range structures broke out and the trending conditions start to organize. The best buying and selling opportunities occur at the key support and resistance levels. There are 3 ways to trade the ranging markets. I'm not going to go into all the details because I want you to get what's here. Like, look at your charts and decide whether the market is trending or ranging. After you check that out, we'll go into more details about the trading tactics and strategies that you will use to trade the trending or ranging markets. If you can't differentiate between the ranging market and the trending markets, you will not know how to use these price action strategies. So the first way to trade these markets is by waiting for price to approach the support or resistance levels, and then you can buy at key support levels and sell at the key resistance levels. See, the market was ranging. Price breaks out a resistance level to indicate the end of the ranging period and the beginning of a new period. After that breakout, the market comes back to retest the resistance level that becomes support before it goes up. That pullback is your second chance to join the buyers if you missed the breakout. But pullbacks don't always occur after every breakout, and when it does occur, it represents a great opportunity with a good risk to reward ratio. What you have to remember is that a ranging market moves horizontally between the support and resistance levels. These are the key levels that you have to focus on. The breakout of the support or the resistance level indicates that the ranging period is over, so that you have to make sure that the breakout is real to join the new trend safely. If you miss that breakout, just wait for the pullback. When it occurs, don't hesitate to enter the market. When you are trading ranging markets, always make sure that the market is worth trading. If you feel like you can't identify the boundaries of support and resistance, this is a clear indication of a choppy market. In Forex, choppy markets are those which have no clear directions. When you open your chart and you find a lot of noise, you can't even decide if the market is ranging or trending. You have to know that you are watching a choppy market. This type of market can make you feel very emotional and doubt your trading strategies as it starts to drop in performance. AKA, if you're chasing a trade, you're going to just start noticing a couple of losses, all right? If you didn't already notice it was in a choppy market, you're a mistake. Correct yourself. The best way to determine if the market is choppy is just by zooming out on the daily chart and taking in the bigger picture. After some training, screen time, and experience, you will be easily able to identify if the market is ranging or if it's a choppy market. The chart in front of you is a very good example of a choppy market that is not worth trading. There are plenty of other pairs to check out. Notice in the chart, though, that the price action in the highlighted area is super choppy. It's moving sideways in a small, tight range. This is a sign of a choppy market that you should stay away from. If the market is choppy, in my opinion, it's not worth trading. If you try to trade it, you will be just giving back your profits shortly after big wins because market often consolidates after making big moves. As a price action trader, your primary time frame is the 1 hour, the 4 hour, and the daily. Price action works on bigger time frames. If you try to trade pin bars or engulfing bars on the 5-minute time frame, you will lose your money because there's a lot of noise on them smaller time frames. The market would generate a lot of false signals because of the hard battle between the bears and the bulls. Besides, there is no successful price action trader who focuses on one time frame to analyze his charts. Maybe you've heard of the term top and down analysis, which means to begin with the bigger time frames and to get the bigger picture, and then you switch to the smaller ones to decide whether to place a buy or to sell the market. Let's say you want to trade the 4-hour chart. You have to look at the weekly chart first and then the daily chart. If the weekly and the daily chart analysis aligns with your 4-hour chart, then you could take your trading decision. If you want to trade the 1-hour chart, then you have to look at the daily chart first. This is a critical step to do as a price action trader because this will help you avoid low probability trading setups, and it will allow you to stay focused on high probability action price signals. All right? Through our top-down analysis, we will always start with the bigger time frame, and we will look to gather the following information. The 4R: support and resistance, the market structure, the previous candle, and the market conditions. In the market structure, the weekly analysis will help you identify the market is trending up or down or if it's ranging or choppy. In general, you'll know what the big investors are doing, and you will try to find a way to follow them in the smaller time frames using my price action strategies. The previous candle is important because the last candle on the weekly chart tells us what happened during that week. It provides us with valuable information about the future market moves. And when you identify these points in the weekly chart, you can now move on to the daily chart or the 4-hour and try to gather information such as the market condition, like what is the market doing in the 4-hour time frame, trending up, down, ranging, or choppy. You could look at what are the most important key levels like the support and resistance, the supply and demand, and the trend lines. You place those and you look for a price action signal, aka a candlestick pattern that will provide you with a signal to buy or short the market. This could be a pin bar, an engulfing bar, or an inside bar, the pregnant bar. Let me give you some examples to help you understand, all right? See in this weekly chart above, we have gathered 2 important points that will help us decide what to do on the daily time frame. The first point is that the market approaches to an important weekly resistance level that will represent a hot point in the market. The second information is a rejection from the key level. As you can see, the price was rejected immediately when it approached the level. This indicates that there are sellers there and they are willing to short the market. What confirms our analysis is the formation of the inside bar false breakout patterns that indicates a reversal. Now let's switch to the daily frame and see what's going on in the market. In the daily chart, we have a clear pin bar candlestick pattern that indicates a bullish signal. If you focus on just one time frame to make your trading decision, you would have bought the market because there is a clear pin bar signal. But if you analyze the weekly chart, you would know that there's a very powerful key level there that will stop the market from going up. So it's better to think of selling the market if there's a clear signal rather than to buy it. Because look what happens next. Analysis works. The pin bar candlestick signal didn't work because the weekly resistance level was a powerful turning point that reversed the market direction. If you want to trade price action based on one time frame, I highly recommend you stop trading because you will just end up losing your entire trading account. You will never become a successful trader. Trading counter trends are very profitable as well, but without the top-down analysis, you will definitely be putting yourself in trouble. Let me give you another example of how you can trade counter trades using your price action trading setups in combination with the top-down analysis. The prices are at a weekly resistance level. Buyers were rejected twice from this level, which indicates that the market is at a hot point and is likely to reverse. What you can do as a price action trader is to switch to the daily time frame and look for a selling opportunity. If you can find a price action setup near the weekly resistance level on a daily time frame, this is going to be a high probability setup to take into consideration. Above confirms our weekly analysis. As you can see, there is a clear bearish signal near the weekly resistance level. The pin bar was rejected from that level, and there is also the formation of an inside bar false breakout. This is a clear indication of a trend change. What happened next? The example shows that the counter trend works if it is well mastered. It is a contrarian approach that requires experience. So if you're a beginner, I highly recommend you stick with the trend. Try to practice as much as you can with the top-down analysis concept with the trend. And when you master trading with the trend, then you can move to trade high probability counter trading setups. There are many approaches used to time the market turns and to plan the trades, and most of these approaches lead to greater confusion and lack of confidence in the results. That's why I created this, to make it simple. Keep it simple. Keeping the analysis simple is the most often the best way to go, and top-down analysis is one of the easiest approaches that I recommend to master if you want to trade the right way. What you have to do right now is open your charts, and guess what it is, Titans? Practice what you learned. All right, go and find those counter trends. Go and find those major reversals. Go look at points of major resistance and support and see what happens. All right. Try to identify the market trends using these techniques. It will be a little bit confusing, but with some screen time and practice, like I said, you will find it easy to identify the market direction. Okay, now we're getting into some juicy information. All right. What we're going to get into now is trading strategies and tactics. All right. First, we're going to identify the market trends. The second aspect is to draw support and resistance, get the levels, draw the trend lines. And the third aspect is to get those signals, the candlestick patterns, understand the psychology behind their formation and the message they send you. These three aspects, which are the trend, level, and signal, are what we will use in our trading approach to make money trading any financial markets. Pay attention, get your notebooks out, get your cheat sheets ready to write in. We're about to get into the pin bar candlestick pattern trading strategy. All right, the pin bar candlestick is one of the most famous Japanese candlesticks. It is widely used by price action traders to determine reversal points in the market. We will learn how in detail to identify potential pin bar signals and the conditions needed for the high probability setups. A pin bar is a chart candlestick. It is characterized by a very long tail that shows rejection and indicates that the market will move in the opposite direction. The area between the open and close, that's called the real body, like we spoke about at the beginning. Typically, all pin bars have a very small real body and a very long shadow. Bullish pin bar is known for its lower wicks, and the bearish one is characterized by its long upper wicks. So the color of the candlestick is not important again. However, the bullish candlesticks with the white body are more powerful than the ones with the black bodies. On the other hand, the bearish pin bars with the real black bodies are more important with the ones with the white real bodies. It's one of the most famous Japanese candlesticks. It is widely used by price action traders to determine reversal points in the market. We will learn how to identify the potential pin bar signals and the conditions needed for high probability setups. A pin bar is a chart candlestick that is characterized by the long tail that shows rejection and indicates that the market will move in the opposite direction. The area between the open and close is called the real body. Typically, all pin bars have a very small real body and a very long shadow. The bullish pin bar that you see in front of you is known for its lower wicks. The bearish one that I'll show you next is known by its long upper wicks. The color of the candlestick is not important. However, bullish candlesticks with the white real body are more powerful than the candles with the black real body. On the other hand, bearish pin bars with the real black bodies are more important than the ones with the white real bodies. Here's that bearish pin bar I was telling you with that long upper shadow. Now, to be honest, quality price action setups sometimes don't exist in the market because you will see you can find a high probability setup and you'll feel excited about it. You'll take a trade with confidence, but in the end, the signal will fail for unknown reasons and you'll be frustrated. This happens a couple times because the market doesn't move due to pin bar formations. That just is like telling us what could be happening. What moves the market is the law of supply and demand, all right? Let me give you an example. If you identified a quality pin bar candle near support level that was key support level in an uptrend market, that would normally signal a very powerful buy. You shouldn't ignore it. But the amount of money that a buyer puts into this trade, if it is less than the amount of monies that the sellers have risked in the same trade, the market will not go in your predicted direction. Now, let me say that again in case I was jumping through that. This is important to understand how the market works. If the amount of money that the buyers put in this trade is less than the amount of money that sellers have risked in the same trade, the market will not go in your predicted direction. If the signal fails, it doesn't mean that your analysis is wrong or the pin bars don't work. It's just that because the market didn't validate your decision, aka the buyers and sellers had a different war than what you saw, which is why you should do from up down. All right. You may ask yourself, why should we look for quality pin bar setups if the market doesn't respect them? As you know, trading is a game of probability. There is no certainty. This is why you should evaluate your pin bar setups from multiple angles. And the fact that you are looking for quality setups from multiple angles just means that you're trying to put the probability of success in your favor, which is a professional mindset for a trader, all right? To determine whether or not a pin bar is worth trading, this price action signal should respect the following criteria. The pin bar formed in a bigger time frame, such as a 4-hour or daily, should be taken into consideration, because if you look at the smaller time frames, you could easily spot a lot of pin bar signals, and these setups should be ignored because on the smaller time frames, they'll generate a lot of false signals. The pin bar formed on line with the direction of the market is more powerful than the one that formed against the trend. If you can identify a clear trend, that means that you know who's in charge of the market. The formation of this candlestick pattern with the trend makes it so effective, as you can see in the next slide. As you can see, the bullish pin bar that was formed in the line with the uptrend work, and they should be taken into consideration. But the bearish ones that were formed against the trend should be ignored. The anatomy of the pin bar is important as well. You have to make sure that the candlestick is a pin bar by looking at the distance between the real body and the tail. Pin bars with the longer tails are more powerful. Pin bars are formed when prices are rejected. This rejection doesn't indicate a reversal signal because this price action setup can form anywhere in your chart. The most important areas to watch when trading pin bars are major key levels such as support and resistance, supply and demand zones, and moving averages. The formation of this candlestick chart patterns in these levels give us clear idea about what's going to happen in the market. All right. If the rejection was near a support level, for example, this is an obvious indication that the bulls are more powerful and they're willing to push the market up. If you understand the psychology behind this price action pattern formation, you will be able to predict what is likely to happen in the future. And you will make good trades based on high probability pin bar signals. All right? If you're a beginning trader, I highly recommend you stick with the trend because pin bars that occur in trending markets offer good trading opportunities with high risk to reward ratios. When you master trading it with the trend, you can then move to trade range-bound markets or even counter trends. This strategy is simple. You start by identifying a clear uptrend or downtrend, and you wait for a pin bar to occur after a pullback to support a resistance level. You see how it shows in this picture? It shows you how the price action signal worked if it was traded with the trend. And as you can see, the price was rejected from the resistance level, which indicates that the bears are still in charge of the downtrend. The formation of the pin bar indicates the end of the retracement move and the beginning of the impulsive move at the resistance level in line with the downtrend. This is a high quality setup because all the following criteria were respected. 1. The pin bar was well formed and it is in line with the direction of the market. 2. The rejection occurred near a major key level, which represents a hot point in the market, that resistance level. 3. The risk to reward ratio is good and it is worth trading. Sometimes, even if the market is trending, we can't draw support or resistance level because the price moves in a certain way which we can't spot static key levels. If you're in this situation, all right, take a note here. You will use the 21 moving average, which will act as dynamic support in an uptrend market and dynamic resistance in a downtrend market. I'm going to show you that in the next slide. As you can see in the chart above, the market was trending down. Using that 21 moving average helps us to identify dynamic resistance levels and high probability pin bar setups. The 4-hour chart in this picture shows how the 21 moving average can help us find key points in the market. When prices approach the moving average, the buying pressure takes place in the market and the price goes up. The pin bar signal is clear on the chart, and it's also because the trend is bullish. The price action setup has a bullish anatomy, and the rejection from the 21 moving average is a confirmation signal to buy the market. Just add all those things together, confluence, and you have a great trading signal and setup. We'll be talking about trading tactics next. When we identify the trend, either upwards or downwards, and the level, either support or resistance, and we find a pin bar near these levels in line with the direction of the trend, the second step is to know how to enter the market based on this candlestick pattern. According to my experience, there are different entry options when it comes to trading pin bars. It all depends on the candle's anatomy, the market conditions, and your money management strategy. Number 1, the aggressive entry option. This method consists of entering the market immediately after the pin bar closes without waiting for a confirmation. This strategy will help you catch the move from the beginning, because sometimes the price goes higher even after the close of a pin bar. If you're not in the market, the trade will leave without you, as you can see in this example. The chart shows how an aggressive entry could help you to execute your trade in the right time without being left by the market. And as you can see, we took this trade because we had 3 important elements. The trend, the market was trending down, and in this case, we look for a selling opportunity. 2, the level. In this chart, we had a support level that becomes resistance. And 3, the signal. The clear pin bar signal was formed after the retracement back to the resistance level. When you have all these 3 elements in the market, you just place your trade after the close of the pin bar, and your stop loss above the long tail, and your profit target will be the next support level in case of a downtrend. In the case of the downtrend. And these 3 elements are quite enough for you to find high probability entries in the market. The second option was the conservative entry option. The conservative entry option. This strategy consists of entering the market after 50% of the range bar retracement. This strategy comes and will sometimes work, as it will give you a 5-to-1 risk to reward ratio. Sometimes the market will leave without you. The illustration I show gives us a clear idea about the power of conservative entries. As you can see, this entry method helps us decrease our risks and increase our rewards. The trade above has more than a 5-to-1 risk to reward ratio. One trade like this every month is quite enough to generate decent income. Trading pin bars in a range-bound market, all right? We can say that a market is ranging when the prices don't make any higher highs or higher lows and start trading horizontally between definable levels of support and a definable level of resistance, which means those 2 points. There has to be 2 points. Once I see that the market changes to its behavior, I have to change my tactics and adopt a trading strategy that fits this new market condition. To confirm a ranging market, I have to look for at least 2 touches of support levels and 2 touches of resistance levels. And once I have identified the range, then it becomes very simple to trade it by going long when the price reaches the support level and going short when the price reaches the resistance level. As you can see in this chart, the price moves and approaches the key support or resistance level. We have an opportunity to buy or sell the market. We just have to wait for a clear price action setup, such as a pin bar candlestick. As you can see, this illustration shows us 3 trading opportunities. Let me explain to you how you can trade them successfully. The first one is a pin bar rejected from the support level. You can place a buy order after pin bar closes, or you can wait for the market that touches that 50% of the pin bar range. Your stop loss should be placed above the support level if your profit target must be placed near the resistance level. The risk to reward of this trade is very attractive. The second trading opportunity occurs near the support level. You should place a buy order after the close of the pin bar, and your stop loss should be below the support level. Your profit target is the next resistance level. That third setup is an obvious buying opportunity. As you can see, the market was rejected from the support level and formed a pin bar to inform us that the buyers are still there. The market is likely to bounce from the support level. Trading from key support and resistance levels is the easiest way to make money trading range-bound markets. Don't try to trade any setup if it's not strongly rejected from these areas. The second strategy is about trading in the direction of the breakouts of major key levels or waiting for the prices to retrace back to the breakout point, and then you go long or you go short on the market. As you can see, I've illustrated the range-bound market. The price broke out of the support level and retraces back to the point of the breakout, and the formation of an obvious pin bar indicates a high probability signal to short the market. This is how professional traders trade ranging markets based on this price action using technical indicators, this pin bar strategy. Using technical indicators to confirm your entries will increase your probability of the trade being profitable. I'm not telling you that because you have to focus on indicators to generate signals, because this will never work for you. But if you combine your price action strategies with the right indicators, you will be able to filter your signals and trade the best setups. One of the best indicators that I use to confirm my entries when I examine range-bound markets is the Bollinger Band indicator. All right? What you should do is probably write that down to get ready to set your charts up just like I have my chart set up. All right? The technical trading tool was developed by John Bollinger to measure the market's volatility. The strategy is very simple. We will combine horizontal support and resistance with the upper and lower Bollinger Bands false breakout. If the prices are rejected from the major key levels and from the bands, this is a confirmation that the trade will bounce from these levels. If you look at the chart above, you will notice how the Bollinger Bands act as dynamic support and resistance. When the market approaches the upper or lower bands, prices bounce strongly. So if we see that a pin bar is rejected from a horizontal key level and from bands, this is a clear confirmation to buy or sell the market. The confirmation strategy is very simple, as it will help you decide whether to take a trade or ignore it. Because trading is all about emotions, and sometimes you will spot a nice pin bar signal in a range-bound market, but you will find it difficult to make a decision. What you have to do in this case is simple. Just put your Bollinger Bands on your chart, and if you see that the signal is rejected from horizontal level or from the bands, don't overthink it. Don't overthink about what you should do. Just execute the trade, place your stop loss and profit target, then stay away and let the market do the work for you. All right? Place and forget. All right? You know what you're doing. You see the candlestick patterns. You're in the daily. You are not looking for short movements. You are looking for actual pattern trended movements. And those movements are never going to just be short. They're going to be highly profitable over days, over weeks. Okay? It's not something you open and close. This is not the strategy I'm teaching here. We're not opening and closing trades. We're catching trades and keeping the full scope of that trend. We're catching all of it. All right? And if we can, by confirmations and second confirmations, we'll stack trades on them as they're moving up in that trend until that trend stops, consolidates, reverses. Write this down and always remember it. Execute your trade and your stop loss. Forget, then stay away. Let the market work for you. Don't get caught up in the stress and the anxiety of the market after you've already fucking got the signal. Just place and trade and leave. Or go find another high probability setup that you can now attack again. Hopefully you haven't used all of your leverage, because that would be stupid. All right? You guys are good. We're getting there, Titans. We're getting there. That was one strategy down. All right? We got a couple more to do. Let's get it. The daily chart above shows us how this indicator could help us execute our trades with confidence. The false breakout of the resistance level that was made by the pin bar is a powerful signal to short the market. The trade was confirmed by a false breakout of the upper band, as you can see, right? Remember, this technical indicator is just use a confirmation tool in range-bound markets. Do not use Bollinger Bands to generate signals. Use it always in combination with horizontal key levels, and you will see how this strategy will affect positively your trading account. Okay? In conclusion, I recommend you practice these strategies as much as you can before opening and funding your trading account. Use a demo account. Practice it up. But in my experience, when I first learned these candlestick patterns, the first 3 months after that were ridiculous for me. Then I started veering off and practicing other, strategies and whatnot, and researching to find if I could add anything to this. And most everything that everybody else teaches is just baloney. It just doesn't make Like, yes, it makes sense, but nobody in their life needs that much information to trade something that is literally either buying or selling or in consolidation. That's three things that you're looking for, okay? Like, it's not that difficult. People make it difficult, though, all right? Let's keep it simple, and let's keep it moving. Ooh, some sauce. The engulfing bar candlestick pattern. Yes, sir. This is one of the most powerful and profitable price action patterns. Knowing how to use it properly as an entry signal will tremendously improve your trading profitability. What we'll be learning about is how to use the engulfing pattern properly. It doesn't matter if you're a beginning or an advanced trader. If you are looking for seriously a better trading strategy more than what you've been using, you have came to the right place. You have come to the right place. All right? What is an engulfing bar pattern? This reversal candlestick pattern consists of two opposite colored bodies in which the second body engulfs or covers entirely the first one. A bullish engulfing pattern forms at the end of a downtrend, and it provides a clear signal that the buying pressure has overwhelmed the selling pressure. In other words, the buyers are now involved. A bearish engulfing pattern occurs at the end of an uptrend and is a trend reversal indicator and shows that the bulls are no longer in control of the market and the price is likely to reverse. I'll show you some examples. Here's a bullish engulfing bar. As you can see, that bullish candle fully engulfed that bearish candle, which is the black candle. The white candle is the bullish, and that was at the end of a downtrend. It signified that literally, I'm telling you, I've traded this too many times. Beautiful setup. You see one of these motherfuckers, you take it, all right? Especially on the daily or the weekly, especially at the end of a trend. Like, this is money. This is 100% accurate signal. 100%, okay? It's never failed. Never. And this is that bearish engulfing, all right? That you see that the market is clearly definable, either uptrend or downtrend. The engulfing candle comprises of two candlesticks. The first body is entirely engulfed by the second, and the second real body is opposite of the first real body. So you see in that bearish that freaking bullish candlestick is fully engulfed by the bearish candlestick, which shows at the top of that uptrend shows a clear reversal, indicating it is going to go down. All right, until you get another indication of a reversal, it's going into a downwards trend. Now, how do we trade these engulfing price signals? To trade properly, this candlestick pattern, you need to respect three elements again. Remember, I'll repeat these. The trend. If you look at any chart, you will notice that there's times where the market is moving clearly in one direction. There are times where it's moving sideways. To be honest, trading engulfing bar patterns with the trend is the easiest way to make money in the market. All right? You don't need to be highly knowledgeable about technical analysis to determine whether the market is trending or not. Make it stupid simple. If the market is making a series of higher highs and higher lows, it is in an uptrend market. If it is making a series of lower highs and lower lows, it is simply in a downtrend market. All right? The illustration shows a clear uptrend. You don't need to use an indicator to determine whether the market is trending or not. Just look at your chart and try to apply the concept of higher highs and higher lows and vice versa. When you're analyzing your charts, bear in mind that the markets move in trends, and trading with the trend is the most important element in your technical analysis. There's no more important than the trend. Don't ever try to fight it or control it, or else you will pay expensively for trying. The engulfing bar pattern with moving averages provide a very profitable trading system and strategy. However, the lack of knowledge about using the moving average can dramatically damage your trading account. Traders that use moving averages, they use them in different ways. One, as a trend following tool to identify the direction of the trend. So they'll buy the market when the price is above 200 simple moving average, or they'll sell the market when it's below the 200 simple moving average. Another one is to determine whether the market is overbought or oversold. We will just watch how the price interacts with the moving averages. For example, in an uptrend, if the price moves far from the moving averages, this is an indication that the market is overbought. Another one is to predict the trend change by using the crossover strategy. If a moving average crosses over another, it is a signal of a trend reversal. As in any trading system, the moving averages have disadvantages. This is why you have to know how to use it successfully under the right market conditions. This technical trading tool doesn't apply to all markets. Don't ever try to use it in range-bound or untradeable markets because you will get a lot of false signals and you will definitely blow up your trading account. To the best of my knowledge, using the moving averages as dynamic support and resistance in trading markets in combination with engulfing candle bar signal is literally the perfect 100% way to make money in the market. All right, the strategy is very simple. We will use the 21 and 8 simple moving average on the daily and the 4-hour time frame. We will define a clear bullish or bearish market, and we will simply buy when the price pulls back to the moving average and an engulfing pattern forms, as you can see here in this chart. All right, see how it comes down and touches that dynamic, that 21 moving average, and the 8 moving average. And it creates that bullish engulfing pattern right there. That bullish bar is engulfing the bearish bar, which is what makes it a bullish engulfing pattern. Okay, it's just that clean, man. Go ahead and go into your charts and look back and try to see if you can find some engulfing bars right now. Conversely, if the moving average is trending down, it shows that the market is in a downtrend. Again, we sell when the price retraces to the moving average. In the screenshot, I show you how the price interacts with the moving averages as dynamic resistance level and how the engulfing bar pattern represents a high probability setup. As you can see, that bearish bar is engulfing the bullish bar, all right, twice. But in this continuation bar, the second one, it is a bearish bar engulfed by a bearish bar, which is a continuation, which a lot of people get messed up, and I've seen it taught incorrectly. They will tell you it's literally that simple. If it's a continuation, you'll see two of the same next to each other. If it's a start, or if it's also another continuation or a confirmation of that sell after it's broken through that level of resistance there, like, it's just once again, go ahead and go look for some bearish engulfing patterns. Look for them bullish engulfing patterns. Look for that trend. Just do a little bit of homework right now. Do yourselves a favor. I mean, obviously you could just push through all of this and listen to everything, but you're not going to get what I'm trying to get to you. If you go and look at it like I'm telling you to look at it, you're going to see it for yourself. You're going to see those patterns start to form. You're going to start memorizing them in your brain so that when you look at it, you can see it with your naked eye, and it's boom right there. Oh shit, let's go. Let's hit this trade. Let's get this money. All right, Titans, let's get it. How do we trade the engulfing bar with the Fibonacci retracement? Traders use Fibonacci in different ways. However, the most important Fibonacci retracement levels are the 50% and the 61% Fibonacci retracements. Knowing how to use this tool in conjunction with the Japanese candlesticks will definitely maximize your profit potential. According to the chart technicians, the most major moves retrace around the 50 or the 61 Fibonacci retracement. This knowledge will provide you with the ability to predict with high accuracy the next major moves in a trending market. The strategy is very simple. You define a clear uptrend or downtrend, and then you define major corrective levels using Fibonacci retracement tool. If you see an engulfing bar pattern matches up with the 50 or the 61% levels, it is a powerful price action trading signal like we see in the chart here. In the example, the engulfing bar price action signal matches up with the 50 and 61% Fibonacci retracement level. The resistance level that becomes support is another confirmation to take this high probability setup. This trading strategy is very powerful. In the next slide, I'll show you another example that illustrates the power of 50% and 61% Fibonacci retracement. Trading markets from 50 and 61% Fibonacci levels means you are trading from better price levels. And as a result, you will put as many probabilities in your favor as possible. And that will allow you to become one of the most successful traders. All right? You see how this price action comes, goes and breaks through that. It does its pullback. All right? In the daily, that's a pretty big pullback. All right? You could have bought there at the bottom there, as you see. There's that morning star pattern all the way at the bottom here, but we'll get into that. But you see it does that engulfing bar as it comes up to retouch that resistance level, which is really telling you right there, all right, cool, that is not a reversal, that is just a retracement going into this sell, and it's going to be a great one. All right, and we're retracing near that 61.8 Fibonacci level. Now you don't have to, it doesn't need to be on point to that. Don't think about it like that. It's just right there in that zone. All right, and you'll see when it creates that engulfing bar right there as a confirmation. There's 2-3 confirmations right there. All right, now you got a good fucking sell. Trendlines give traders an idea about the psychology of the market, especially the psychology between buyers and sellers. Moreover, it allows professional traders to determine whether the market is pessimistic or optimistic. In trending markets, we simply use trend lines to highlight a trend by connecting swing highs and swing lows in price. This way, it helps us find the high probability entry setups in line with the general trend of the market. As you can see in the illustration, by connecting the extreme highs, we had a trend line that acted as a resistance level, and the formation of the engulfing bar pattern shows you a good selling opportunity. If you had used just horizontal support and resistance levels, you would miss this profitable trade. Learning about how to draw trend lines is never a bad idea because it is the simplest analytic tool that you can use to analyze financial markets. It works in all markets, whether it's Forex, commodities, futures, or options. In the chart that you see, it shows a bullish trend. The trend lines act as support level, and the price action signal that occurred, which is that engulfing bar, created a great buying opportunity. If you've seen that drawdown, that drawback there, and it hits the trend line, you see it coming up and coming up. You don't know if you're unsure. You see that pattern happen. Now you're for sure. Now you know that is a perfect trade and you can get in there and your risk to reward is perfect. One of the most difficult markets to predict can be the sideways and ranging markets. I always recommend traders to focus on trading trending markets. But the problem is that the markets spend more than 70% of their time in a ranging motion. If you focus on just trending markets, you will probably leave a lot of money on the table. This is a reason why learning how to approach the range-bound market is a must if you want to make a decent living trading financial markets. What is a range-bound market? Again, when a market stops making higher highs and higher lows in the case of an uptrend or lower highs and lower lows in the case of a downtrend, the price starts acting between specific high price and low price. This is a clear signal that the market is ranging and no longer trending. As you can see in the illustration, the market is trendless. It is trading between horizontal support and resistance, and you can't apply the same techniques that you use in a trending market to trade engulfing bar patterns in range-bound markets. Let me give you an example. When you're driving your car, you don't always drive the same way. If you're driving downtown, you try to drive slowly because you know that driving fast can put your life or others in danger. But when you're driving on a highway, your driving style changes completely because you know you can drive fast. So you always try to adapt your driving style to the appropriate situation. You have to do the same thing when you are trading the engulfing bar pattern because all price action strategies we discussed before will not work in range-bound markets, and you will have to use the right techniques that fit in these market conditions. Before talking about the right way to trade trendless markets, you have to be selective about trading range-bound markets to protect your trading account. Because not all sideways markets are worth trading. You have to know how to differentiate between sideways and choppy markets, as you'll see in the next slide. In the illustration, the market trades in a crazy way. We can't identify major levels of support and resistance, and we have to stay away from these types of markets, otherwise you will definitely damage your trading account. Trading the engulfing bar candle in range-bound markets is very simple. The first strategy is going to be about trading this price action pattern, the major support and resistance levels, like we see in the next slide. The second strategy is to trade the breakout of the range or to wait for the pullback, see in the next slide. And this third strategy is to trade the false breakout of the major support or resistance level. False breakouts are one of the most powerful price action strategies. It occurs in all type of markets, and if you know how to use it in combination with the engulfing bar pattern and a major support level or resistance, you will make a lot of money in the market because you will buy intelligently at the bottoms and sell at the tops. As you can see in this chart, it comes and bounces between these levels, makes 2 points. There you know you have support and resistance. Now coming at this third point at the bottom, support level, you could buy there. Now you coming up, it's hitting this resistance level, and you could sell there. As it comes down, you see, if you look closely enough, there is an evening star pattern that occurs after it breaks support level, comes up, and that's that drawback. And as it makes that evening star pattern, right and after that, it makes a bearish engulfing pattern, which is a double pattern fucking verification for a sell. Now that right there, if you don't think it's a sell by now, you're going to miss out on a lot of money, because that would show a very significant sell. Now, trading engulfing bars with supply and demand zones. Now you may ask, what are supply and demands? Supply and demand areas are more powerful than support and resistance. It is a place where banks and institutions are buying and selling the market. If you can identify these turning points, you will make a difference in your trading account. To trade an engulfing bar pattern successfully with supply and demand areas, you have to be able to identify quality supply and demand levels on a chart. According to my experience, there are 3 factors that define quality supply and demand areas. One of them includes the strength of the move. Pay more attention to the way the price leaves the zone. If the market leaves the area quickly, this is an indication that the banks and institutions are there. A lot of money is able to move the market. I promise you. You'll see it. The second one is good profit zones. You have to make sure that the level provides a good risk to reward level. All right. The third is bigger time frames. The daily and the 4-hour supply and demand areas are the most powerful zones in the market. This chart shows a quality supply area, and as you can see, the move was very strong, and that indicates that the banks and institutions were there. The formation of the engulfing bar was a clear signal that the bears are still willing to sell from the same price level. We've learned how to identify high probability setups in the market. This doesn't mean that all engulfing bar patterns are worth trading, but I just have to say that just for risk, everything's always a risk. It could, like I said, the buyers could not have bought as much as the sellers, blah blah blah, have risked, and that could change the market up. So watch the news. Everything, that's another thing that I didn't actually add in this course, but I'll tell you right now. Have a news filter. Know when the news is going. Don't trade during the news. Price action signals with low risk and reward ratios should be ignored. Once the criteria for high probability setups are in place, there is no more analysis to be made. Just make sure that your trade has a potential of 2-to-1 risk to ratio. What I mean is that the amount of money that you will win has to be twice the money that you'll lose, that you'll risk if you do lose, or more. All right, so it has to be 2 times more than you're risking. That's what your profit target should be. All right. As you can see in the example, all the conditions were in place to take a buying order, and the market was ranging, like we discussed before. Major demand and supply zones are the best price levels in a sideways market. The formation of an engulfing bar in the demand area is a good trading opportunity, but you have to look at the risk to reward ratio to make sure that the trade respects your money management rules. This trade has a 3-to-1 risk reward, which increases your chances to be a winner in the long term. Because if you risk $200 on this trade, you're likely to win $600. It is very important to calculate your risk to reward ratio before taking any single trade. Now imagine if you took 10 trades, all right, with a 3-to-1 risk reward ratio on each single trade. And I mean, when you win, you get $600, and when the market goes against you, you lose $200. Let's suppose you lost 7 trades and you won just 3 trades. And if you do the math in your head, you can tell yourself if you're a winner or a loser. 7 losing trades will cost you $1,400, and 3 winning trades will make you $1,800. So as you can see, you lost 7 trades, but you're still making money. This is the magic of money management. That is what professional traders do to protect their assets. And if you are trading, you shouldn't be trading to be an amateur or some poser day trader. You could make money like that, yeah. and especially if you master this, yes. But these day traders that are just trading without any sort of logic or any sort of technical analysis, it's just don't try to be smarter than the rest of the traders. Just keep it simple, like I keep saying. You know what you're looking for. When you identify that engulfing bar pattern and you know all the conditions are in place, just execute your trade. Take the order immediately after the price action signal forms. Put your stop loss below the candlestick pattern and look at the chart. Find the next support or resistance level, and that's going to be your take profit. When you set your protective stop and your target, don't ever look back. Just let the market tell you if you're wrong or right. This will help you trade successfully out of your emotions. Inside bar candlestick pattern is one of the most powerful chart setups that professional traders look out for. However, I don't know why, but a lot of traders fail to trade it successfully. The lack of skills or knowledge and a poor education are usually the main reasons why most price action traders don't make any money using this Japanese candlestick trading method, because they're just being taught just patterns, but they're not being taught in conjunction with everything else. Like, it just doesn't make any sense, because if you read anything about the man who created the candlestick patterns, he looked at how emotions played a part in the market moving up or down, and how the volume of the market and where it was going was going to help him make a decision, and he identified these candlestick patterns, which I took the most profitable ones out and tested them out over the last 7 years. An inside bar is two candlesticks. The first one is called the mother candle, and it's big and large. And the second one is smaller, and it's located on the inside of the mother. I really, really implore you to pay attention, because this is what I look for, this pattern right here. When I see a trend starting, like when it's a reversal, I'll watch for that to place my my trailing trades. So I stack trades. As it goes up, I see a new entry, I place trades. Like if you're trading full time, you'll see that, and you'll want to capitalize on your money and how much you can make, okay? So the last slide and this slide, these both are showing inside bars at the top and at the bottom. And as you can see, the second small bar is completely contained by the first one, which is the opposite of an engulfing bar pattern. The inside bar is seen usually as a reversal pattern when it's at the top or bottom of a trend, all right? But when it's inside of a pattern, it's considered a continuation. That's what you need to understand about these patterns. You have to know when it is a reversal, and you have to know when it is a continuation. You have to know that by placing supply and demand zones, support and resistance, trend lines, all of that, okay? And those moving averages and oscillators, all right? So all of that in conjunction, and you'll be able to trade this properly. According to Thomas Bokolski, a successful inventor and trader with over 30 years of market experience, a bearish inside bar pattern in a bull market can indicate a bearish reversal in about 65% of the time. In a bull market, it represents a bullish continuation in about 52% of the time, which is why I say I look for that when it's doing the reversal into a buy. It's just perfect. The bullish abandoned baby, he calls it, is considered a bullish reversal pattern, and 70% of the time, it is successful in the bull markets, and it's successful 55% in the bear markets. It's pretty high probability. Hey, let's talk about how to trade the inside bar candlestick patterns. But first, let's talk about the psychology behind the pattern formation, because that is what is important here. The inside bar formation indicates a period of consolidation. In case of the bullish trend, it reflects that the bulls are not buying any further on the second day, and it represents by a black small candle on the second day after a strong uptrend. In the case of a bearish trend, it means that the sellers are not in control of the market anymore, and it is reflected by a small white candle after a strong downtrend. Your understanding of the psychology behind this pattern will help you better understand and identify major turning points in the market and time correctly your entries and exits, okay? An inside bar can be traded successfully in trending markets, particularly if the market is moving strongly. Because the formation of this price pattern provides you with a great opportunity to join the great move, the big move. The strategy is very simple. All you have to do is identify a strong trend, wait for the formation of an inside bar pattern in line with the direction of the market. The formation of this pattern indicates that the market pauses before making its next move. This will allow you to enter the market at the right time to make them big profits. As you can see here, the market is trending down. The formation of inside bar patterns gave us 3 opportunities to join the trend. If you're just starting to use my approach to trading, you will only look for selling opportunities. This way, you're not fighting big institutions and central banks. You're just trading in the direction that is favored by the market. You can place a sell order after the breakout of the pattern as it is mentioned in the chart above, and your stop loss order should be placed above the mother candle. Your profit target would be the next support level. If you look at the chart, you can see how the price action setup worked significantly as a continuation pattern. And to be honest, you're not going to take all of these signals into consideration. You have to look for significant patterns that form in specific areas in the market, such as support and resistance, Fibonacci retracement levels, moving averages, or pivot points. Don't worry about that. We'll learn about the important trading tools that we will need to use in combination with the inside bar setups to make the best trading decisions. This can be very complicated if you don't focus on the most important basics, such as support and resistance levels. These areas represent a psychological level where the game is played between buyers and sellers. Let me give you an example. If sellers overcome buyers, they will push the price below support level. Some buyers will get afraid to lose money because they see that the support level is broken, so they will get out and sell the market again to cover their losses. Other participants will notice the sellers are in control of the market and they will decide to sell the market and help the bears push the price to go down. As a trader, if you have enough knowledge about support and resistance levels, when you open your charts, you will notice that the support level is broken and that bears are in control of the market. This is a good selling opportunity, right? But the question is, what is the right time to enter the market? The inside bar pattern is one of the most reliable price action signals that will give you the right time to enter the market and make big profits. And once again, if you understand how to use it in combination with these levels, you will get clear indication of what the market is trying to tell you, and you will be able to make some very good trading decisions. This chart, it shows how sellers broke the support level. The formation of the inside bar pattern after the breakout of this level signals indecision in the market. Right now, nobody knows if the support level is really broken. If you sell at the market immediately after the breakout of this level, you're making an aggressive entry, which sometimes is a little tricky and dangerous because the breakout has not been confirmed yet. But if you are used to trading inside bars and you understand the psychology behind their formations, you will know that the safest entry should be at the breakout of this pattern. The breakout of this candlestick pattern is a clear confirmation that the market is not still in an indecision period and that sellers are obviously in control of the market. In this chart, it shows how the market participants interacted with these levels and how the resistance level acts as a barrier. The market had a difficulty rising above this horizontal level, preventing buyers twice from rising any further. But in the third attempt, buyers broke through the resistance level. What is interesting is what's happened after the breakout. Look at the chart again. You will notice that there's a clear inside bar pattern formed over there. The formation of this price action pattern indicates that the breakout is not yet confirmed. Remember, an inside bar formation means indecision and hesitation. So you have to be careful and bear in mind that a false breakout scenario is possible. What will make a difference between you and other traders is your deep understanding of how this pattern works. In the chart, you will know when the best time to place an order should be after that breakout of the inside bar pattern, not after the breakout of the horizontal level. Here are a few tips on trading the inside bar price action setups. 1, trade the bigger time frames. I'm not against trading lower time frames, and you can trade the setup on 5-minute time frames using other technical indicators to filter your signals and just take high probability setups. But you have to be an experienced trader. If you're a beginner, I recommend you stick with trading the signal on bigger time frames such as the daily or the 4-hour. Trading this setup on the lower time frames will increase your chance to overtrade the market and take low probability price action signals. This is the quickest way to lose your account. If you focus on the bigger time frames, this will allow you to set and forget your trades instead of being emotionally controlled by the market, sitting there staring at it, wondering if it's going up or down or up or down. Like, no, don't do that to yourself. The second tip would be trade the dominant trend. You should start trading inside bars in line with the direction of the market, especially in a strong bullish or bearish trend. But don't ever try to trade against the trend, even if you're a newbie. It's just not smart. Like swing trading it up and down, hedge trading, whatever you want to call it. My third tip, trade only from key levels. Okay? That's when you'll make the most profit. You'll get the entire movements. Not all inside bars are worth your hard-earned money. There are specific locations where the setup works great. Just make sure that your signal is located at a key level in the market. So when you're reviewing this, doing your homework for this pattern itself, when you want to check this out, I know this, I guess, is a lot of patterns. I already have them all memorized because it's been years, and I just see them when I look at the market, but you'll get there. That's why I said make a cheat sheet. I actually will be producing some cheat sheets and note cards, so if you guys want to get them, just hit me up. The fourth would be trading with confluence. All right, that means combining different signals to make the best trading decisions. To trade this concept, you need to look for a point in the market where two or more levels are coming together and wait for an obvious signal to form. It's literally taking your trades from 50-50 to 90%, you know. This trading method will give you confidence in your trading approach, and it will allow you to avoid over trading. Have you ever placed a trade with confidence thinking that the market was just going to keep going up or going down, but the price hit your stop loss right before it starts turning around to the predicted direction? I've been a victim of stop hunting. I've been so disappointed several times this happened. Banks and financial institutions know how we trade the market. They know how we think, and they know where we put our stop losses and our profit targets. This is the reason why they could easily take money from us. One of the most famous strategies that the big players use to take our money from all of us regular traders is called stop loss hunting strategy. This strategy consists of driving prices to a certain level where there are massive stop loss orders, and the purpose is to create liquidity, because without liquidity the market will not move. So once stop losses are hunted, the market goes strongly into predicted direction. Okay, the interaction between the big participants and novice traders create repetitive patterns in the market. And one of the most important candlestick patterns that illustrates a big financial institution manipulation is the inside bar false breakout pattern. All right, your understanding of this repetitive setup and your ability to detect it in your charts will help you better exploit it to make more money instead of being a victim of the market makers and bank manipulations. All right, this price action signal is formed when price breaks out from the inside bar pattern and then quickly reverses to close within the range of the mother bar. As you can see, there are two types of price action patterns. A bullish inside bar false breakout that forms when the market is trending down, and it is also considered as a bullish reversal signal when it's formed near a key support or resistance level. A bearish inside bar false breakout that occurs on a bullish trend and is seen usually as a bearish reversal pattern when it's found near an important level in the market. This setup can also be considered as a continuation pattern if it's traded with the trend. In my own experience, the most important levels that traders should look for to trade signals are the following: support and resistance levels, supply and demand zones, Fibonacci retracement levels, particularly the 50% and the 61%, 21 moving averages and trend lines in trending markets, horizontal levels on range-bound markets, and if you can see in this chart, here's an example of how to trade the inside bar false breakout in a trending market. As you can see, the market was trending down, and that indicates that sellers are in control of the market. So if you decide to sell the market near the resistance level, all probabilities will be in your favor. But the question is when to enter the market and where to put my stop loss, huh? You enter the market aggressively before the breakout of the mother candle, and you put your stop loss above it. The market will take your stop loss and go into the predicted direction, so don't do that. The big players hunt novice traders' stops before pushing the market to go down. If your stop loss was near the resistance level, you would be out as well. If you don't understand the reason why, it's simply because you are a victim of the big players' hunting stop strategy. If you're familiar with trading the inside bar false breakouts, you will understand what happened in the market, and you will simply take advantage of this manipulation instead of being trapped by the market. In this chart, the inside bar false breakout gave us a good selling opportunity. If you're able to identify the setup and you understand the psychology behind it, there should be no reason not to get into the position. Trading the inside bar false breakouts with Fibonacci retracements. I don't know if you're really familiar with this technical trading tool. However, I will show you how to use it in a simple and efficient way in combination with the inside bar false breakout. It's just perfect and simple. What you have to know is that in an uptrend or a downtrend, the market creates impulsive moves and pullbacks. Fibonacci retracement levels help us highlight the most important pullback levels in the market. The best Fibonacci retracements levels that I personally use are the 50% and the 61% levels. Now that you have the steps necessary, that's all it is. What I just showed you, those strategies, those patterns, trend lines, support and resistance, supply and demand zones, how I explained why there's a buy or a seller, how you can see the chart and how you can see the candlestick and how it can tell you what's going on in that hour, that 4 hour, that daily, that weekly, so you can determine what to do. Now let me show you some examples. All right, we all love visuals. Look at this first example. As you can see, the market is trending down. So as a price action trader, I will try to follow the trend and look for powerful signals at the most powerful key levels. That first signal we got right there is a pin bar that was rejected from support level that became resistance. The second factor that supported my decision to sell the market is the rejection from the pin from the 50% Fibonacci retracement mark. All right, that third factor that encouraged me to take this trade, is rejection of the pin bar from the 21 moving average that was acting as a dynamic resistance level. Now that second signal is an engulfing bar candlestick pattern. As you can see in the chart, this candlestick pattern was formed at a resistance line in line with the direction of the market. This is how you can trade, okay? These trending markets using what I'm teaching you. It's simple. Just identify the trend, identify the key levels. It could be support and resistance levels, the 21 moving averages, or the 50 and 61% Fibonacci retracements. Wait for a pin bar, an engulfing bar, an inside bar, or an inside false breakout to form near these levels in line with the direction of the market. And then execute your trade. As you can see here, the market is trading horizontally between the support and resistance level. This market is completely different from trending markets, and the strategy to trade it must be different as well. In ranging markets, we trade from the boundaries, I mean the support and resistance levels. And we don't ever try to trade inside that range, okay? You start from the top, you start from the bottom. In the chart above, we had two powerful signals. The first signal was a pin bar that was strongly rejected from the resistance level, and the second signal was an inside bar formed near that support level.